1.4 billion in fraud. Well, is that what's going on? Well, that's the accusation. Tesla Q is right back at it, and this time they've got the backing of the Financial Times to spin some clever yarns. Other publications have looked at the numbers and taken it a step further to further their own agendas. I'm looking at you, Electric. But is it real, or is it just another bit of nonsense? Spoiler alert, it is nonsense, and I'll show you why. I'm Brian. Welcome to Futuraza. So let's get right into it, shall we? 1.4 billion is a lot to fall through the cracks, even for Tesla. When money spent on assets doesn't result in assets, the Financial Times here working their wizardry poorly. And you know it's going to be a fair and balanced article when it starts with a picture like that. Good job. I mean, I appreciate you letting your biases be known right up front, but even for you guys, that's pretty bad. As Tesla car sales and share price plummet in response to Elon Musk's political and physical stances, we would like to draw readers' attention to something puzzling in the group's accounts. So first of all, you can't sell a car until you build it. Model Y, their bestseller, was not for sale. So definitely that's nothing to consider. That's just something outside of the scope of this genius bit of wizardry. Compare Tesla's capex for the last 6 months of 2024 to its valuation of the assets. That money was spent on. 1.4 billion appears to have gone astray. The sum is big enough to matter, even at Tesla, and comes at a moment when attention is returning to the group's underlying numbers. Now that its fully diluted stock market valuation has crashed from 1.7 trillion to below 800 billions. Closer look may also prompt investors to ask questions, such as why a business with 37 billion cash raised 6 billion of new debt last year. Would it? Do you know what the 6 billion of debt is? Because if you don't know, maybe you should find out. A lot of it. Okay, well, we'll get to that. First, consider the apparent anomaly. Tesla's investing heavily, particularly in AI infrastructure. It intends to spend at least 11 billion in each of the next few years, aiming to take advantage of opportunities in robots, computing, and batteries. Correct. Looking at last year, Tesla spent 6.3 on purchases of property and equipment, excluding finance leases net of sales. On the balance sheet, however, the gross value of property, plant, and equipment rose by only 4.9 billion in that period to 51 billion. Note 7 to the financial statements has the breakdown. So this sounds nefarious. Surely something's up. We'd expect the numbers to tally. Well, you wouldn't. You'd expect it to be close. If only there were some footnotes. Tesla reports the gross figures and accumulation depreciation so we can see how the net figure is arrived at. It didn't disclose any sales or material asset impairments that would account for the missing 1.4. We're sure auditors at PwC would be alive to the important signal such declarations of malinvestment would send. Alive. Is that the right word? 4X seems unlikely to explain the gap either. Yes, I think that's true. It could make up a small part of it. So Tesla's gap is also unusual by its own standard. The chart doesn't appear because I am not giving Financial Times 1 penny to bypass their paywall. The positive number indicates that the balance sheet value of assets rose by more than the capex. So how could, well, maybe they overpaid for something. Can you think of anything they've bought in the last year that they may have had to overpay for in order to get, specifically in the quantities that they needed them? Because I can. Tesla did not respond to requests for comment. Correct. They don't. Everyone knows that for the last 3-4 years, maybe 6 years now, they don't. That's not something they do. Perhaps the assets will show up next quarter. Correct. It's also possible that the recent presidential endorsement will boost sales and that some would-be buyers are waiting for an updated Model Y to hit showrooms. Great. But that has nothing to do with what we're talking about. No part of this has anything to do with that. If not, the question is, what are they doing with their cash and where the money is held? That may become more pertinent. 15 billion of operating cash flow. It invested 11 into its business, didn't pay a dividend or buy back shares with its large cash pile. It puts Tesla in a very select club of large companies that do not. Yet Tesla also raised a net of 3.9 billion in new financing on top of the 2.6 billion raised in 2023. So check it out. Recourse debt that Tesla has is about $7 million. 7 million. 1M, no B. They have a lot of debt that is recourse lending, like the leases, like financing, things like that. And the terms they have on their line of credit is something like 1.3 or 1.93%. It's very, very low. Yeah. So, and then in those cases, allegedly healthy, but in reality inflated operating cash flows tend to be matched by significantly positive financing cash flows, and a seeming cash cow appears to require large amounts of new debt. You know, Walmart has a lot of debt, a lot. They have more cash than they have debt, but they have debt. Why? Why would you have debt? It's strategic. It's a thing they do. So this story became unavoidable because, of course, of the ding-dongs in the comments. By the way, once again, if you're going to just post troll comments, a very high probability that YouTube will filter them out and no human will ever see them. I imagine some of the trolls are starting to get warnings about their comments because that's a thing YouTube does when you are behaving in ways that civilized people do not. But I mean, whatever, man, you're free to leave whatever comment you like. On Reddit, the site is dominated by very low information people who are very loud. Sometimes they're clever. Sometimes they say things that are popular, and that makes their comments rise to the top like just so much fermented foam. No, what it does is give the highest position to often the dumbest people. If you want to find experts, you have to know where to look. So I went to the subreddit r/accounting and got to hear from accountants. Maybe I'll make this a little bigger. Yeah. Tesla accounting raises red flags. This is cross-posted from Wall Street Bets, the place with meme investment advice. Do not take any advice from anyone there, or at least first ask them what kind of people they are, how smart they are, because that they will tell you. Not is the answer. The article points out that Tesla reports having spent $6 billion on property and equipment in the second half, while property, plant, and equipment rose by only $4.9 billion, saying, I cannot believe this is the entire basis for this article. Imagine if amortization expenses was exactly $1.4 billion, and then I am not an accountant. I don't understand how the dude who brought down Wirecard at the Financial Times didn't look at the supplemental non-cash. Supplemental non-cash. It's exactly 1.41 million or 1.41 billion, 1,410 million at the end of December. That's the number. You found it. This company has fried people's minds. Yes, there are a lot of real ding-dongs out there. Real angry people who are never wrong, except they are. Financial journalism has always been notoriously awful on account of their incentives. Financial reports want you to subscribe. More in-depth ones, like the ones put out by the trading companies, want you to trade. They want you to sell. They want you to buy. They don't get paid unless stock keeps moving, unless you're working with a company that does actual real financial planning. Sometimes they will charge you a management fee. I know JP Morgan has one of those. There are other companies that offer similar services. I do not have good advice on how to pick one. That's beyond my scope. It is not the basis for the entire article. This guy's at -7 points, including one from me. The author, who also brought down Wirecard, mind you, points out that it's also really weird and almost unheard of for a company that's supposedly swimming in cash to not issue buybacks or dividends. What are you talking? Okay, well, the downvote was well earned because that's not how this works. Let's see. Too long didn't read. Capex didn't match the rise, raised $6 billion of new debt, even though they have $36 billion, doesn't do stock dividends or buybacks. This sounds like a stupid article. And it is. And the beauty is this author may know better, but the people reposting and rewriting it as their own definitely do not. They're not using the statements of cash flows, but rather the notes to the financial statements, which break down PP&E before and after accumulated depreciation by assets. I was wrong. They're using the CFS. Okay. Cross-posted from Wall Street Bets. Yikes. Surely the group that YOLOs their life savings on autistic memes and brigaded stocks would have some understanding of accounting finance, right? The difference is primarily the change in fixed assets and the write-off of fully depreciated assets. And another comment, 1.4 billion in non-supplemental cash. So let's talk about that. When you buy something durable, equipment, you get to depreciate it over time. A lot of times it'll be on a computer. It might be 7 years. Well, a lot of companies do not get 7 years out of a computer. So what happens? Well, when they replace it, when it is taken out of service, they fully depreciate it at that time. Was there anything in Q3 and 4 that they would have been depreciating, that they would have closed out depreciation on? For example, old Model Y equipment? Quite possible. There's a lot of equipment that needs to be replaced. Some of it in less than the period of the amortization. That would be an immediate thing that should jump to mind if you know anything at all about the company, which most analysts would. Most analysts would be able to look at that and say, yeah, that's reasonable, that's legit. There's another thread about this on accounting. We'll look at that real quick before we wrap this up because it's getting silly. Some auditor should have looked at the fixed assets, roll forward to make sure beginning plus purchase minus disposals equals ending. With 11 billion spent on fixed assets, the auditor should have been selecting and testing samples to make sure the money was actually spent on real stuff. I would be really surprised if neither of these were done, since they're super basic audit procedures for fixed assets. Who knows? Maybe this is Enron 2.0, but I kind of doubt it. Yeah, so all the answers are there. The article is calculating the change gross of accumulated depreciation using the footnote 7, so we should ignore depreciation. I quickly calculated anyway. In this version of the math, it looks right. In this one, it's closer to right, but doesn't explain it in a way that Doge should investigate. Doge doesn't investigate. Doge reads spreadsheets and makes determinations at a very high level. That this is the Q on this is not good. You buy stuff for 10 million. The stuff you bought was too expensive and it's only worth 5 million. Now you've spent 10 million, but only have 5 million in assets to show for it. Yeah, they could have drastically overpaid for those NVIDIA cards just to get them. They could have bought 5 billion in graphics cards, but paid 6.4 billion. That's something they could have done, whatever the numbers may actually be. You could overpay for those. That doesn't make them worth more. You paid to get them first. That's just one example. But the other is a huge amount of depreciation could have been counted as equipment for the Model Y was phased out. Or maybe it's delayed. Maybe that's not hitting until this year. Great. Then it was Model 3 equipment from last year that may have been depreciated in Q3 or 4, really. So there's a lot of things that could be counted. There's a bunch of ways to skin this cat. And if you think a $800 billion company, $1.7 trillion company is interested in $1 billion of fraud, that would be so transparent that you could see it on the quarterly, that strains credulity. And I don't believe that these, what's a good word to call them? Jackwagons? I don't know. I don't believe that Financial Times doesn't know better. I believe they do know better, and they're being sensational for clicks. And I think all the people reading it are either too stupid or too greedy to know that they've been bamboozled. This is the sort of thing that would have a company, an accounting firm, shut down. Arthur Andersen is no longer an accounting firm. They were dissolved because of their participation in the Enron scandal. And that was mostly legal. I mean, like largely legal. There were accounting tricks they used that were then banned because of them. But definitely shady enough to get them shut down. Nobody would put a rubber stamp on this. And PricewaterhouseCoopers is a very large, very old, a very reputable accounting firm. They're not interested in making a quick buck. They're interested in surviving in perpetuity. Guys, in the comments, what did I miss? What did I misunderstand? If this is the kind of video you like, please consider subscribing. I just passed the magic number, 69,420 subscribers. Passed it last night. Very excited about it. Got a lot of virtual high fives for that one. And if you really love it, you could always support the channel on Patreon, as a patron on YouTube, as a channel member on X, as a subscriber. Doing any of those will get you access to bonus videos, which I've been making 5 to 7 times a week lately. We'll see how long I can keep doing that, but I can keep doing them to some extent at some point, time permitting. Got my big trip starting. That will cut into that time, but I'll see what I can do. Everybody else, like, subscribe, do what you do. Stay tuned to Juicy, and I cannot wait to hear from you clever robots on the flippity flop.